Welcome to a new episode, Deep Dive with Markt, today with Jesse Felder. Hi, Jesse.
Hi, thanks for having me.
Of course. And of course, Florian, and perhaps you introduced yourself to our audience.
Yeah, I basically have been writing an investment newsletter I started it as a blog back in 2005, actually. I couldn't resist writing about what I was watching going on in the U.S. real estate market, residential. It just felt so much like the 2000 stock market bubble to me. So I started this blog in 2005. About 10 years later, I turned it into an investment newsletter. But I began my career at Bear Stearns and later co-founded a hedge fund firm. And basically since, for the last 20 years, I've been just managing my own money and writing about markets.
And guitars, I guess. I see a lot of guitars in the background. Is this a good way to protect your purchasing power in these days?
Well, I don't know. I mean, I don't know actually what they're worth. I bought them a long time ago. I'm sure they've probably held their value. I use them more like, I don't know if you've seen the movie A Few Good Men, where Tom Cruise grabs his baseball bat and he's kind of to help him think about how to manage this case. When I'm kind of frustrated with the markets, I just kind of pick up a guitar and kind of mess around, and it helps take my mind off markets for a little bit and think through things.
Okay, how many did you destroy so far in the last 20 years?
I don't think I've destroyed any guitars. They have been well worn, I'll say that.
All right. Okay, perfect. So you would agree we see the most extraordinary times in our lifetimes about macro. It's incredible what's going on in the world. We have a war in Europe. We have inflation at a 40-year high. We see recession on the horizon. So what's your big picture?
Well, I think, I didn't start out with really any focus on macro at all in my career. I started out as just a traditional value investor focused on trying to find cheap stocks. And I think through the course of my career, I was forced to pay attention to macro just because what was going on with central banks and things with, demographics and interest rates and all these things. And there's so much reflexivity in markets, as George Soros termed it, where there's not really one clear driver for things. The things more kind of affect each other. And if you're not paying attention to the big picture in a macro sense, I think you're missing the majority of what's going on in the markets. So, I've been in focus since, really that Bloomberg magazine article that came out 3-4 years ago proclaiming inflation was dead. To me, that was, one of these wonderful sentiment signals like you got with the Business Week article in 1982 or 3 proclaiming the stock market was dead as an investment class. Those are the types of things that I'm, inflation is here and I don't think it's going away anytime soon. I buy into the Goodhart and Pradhan thesis that they put together in their recent book that demographics inflation's here to stay for a number of reasons, and why we might see a recent near-term top in the rate of change in inflation. I don't think the Fed is going to do near enough to bring it back down without causing a very painful recession. We're probably headed to recession anyways, which is probably going to help the Fed kind of temper its extreme hawkishness that we've been seeing, or at least hawkish rhetoric. There's been a lot of forward guidance and very little action so far. So it's very interesting times, and the monetary policy, inflation, all of these things are probably more important to investors than they've really ever been in our lifetimes.
True.
Speaking about that, the bond market had its worst start basically in history to the year. What are your current thoughts about the U.S. Treasury market? Do you think real yields will keep going up? Do you think the bond channels will still hold? Do you think we see the 10-year at 5, 6, 7%? What is your current valuation of the bond market?
So I think we're probably, one of the things that two indicators that I watch very closely are what I call my macro earnings model. Both of these came from Stan Druckenmiller's work, where in recent years, he's given a lot of interviews, basically since he retired from Soros. about what kind of makes the fundamental side of his approach. One of those is, he talked about during the peak of the dot-com mania in 2000, the challenges he had trying to trade stocks, trying to be, short the run up to the March 2000 peak, and failing at that trade over and over again before he finally decided to try and go long dot-com stocks right before they reversed lower. He lost a bunch of money, decided to take a time out from trading for a little while. He came back to the markets in September and recognized that the dollar, interest rates, and oil prices had all been rising for a prolonged period of time and in a strong way. And when you see that trifecta, it usually almost always leads to an earnings recession in 2 years out. 12 to 24 months out. So what have we seen over the last, 2 years? We've seen rapidly rising interest rates, strong dollar over the last 12 months, at least 18 months. We've seen rapidly rising oil prices, right? From negative to over $100 a barrel. So this tells me that we're probably headed for a pretty deep earnings recession, potentially by the end of this year and into next year. So that's usually kind of paired with recession itself. Another, brings me to another Druckenmiller indicator, which he said the best economist he's ever seen is the inside of the stock market. Not the stock market itself, but the relative performance of cyclical sectors in the stock market. So if you look at what have retail stocks been doing relative to the S&P 500, they've been extremely weak for well over a year now. They've been essentially leading to the downside. You look at transportation stocks, right? They've been hammered. Look at another good one to look at is small cap relative performance. I mean, typically when interest rates are going up, small caps are leading the stock market to the upside, and they've been doing the exact opposite. Bank stocks are another good example. When usually rising interest rates are good for banks, when banks underperform in a rising interest rate environment, that's a sign that we're reaching the point in time where rising interest rates are starting to put stress on the economy and potentially create a recession. So you have all these cyclically sensitive sectors in the stock market also pointing to recession. So this is my long-winded answer, a way of saying that somebody like Stan Druckenmiller, I think, would be looking to look for a top in interest rates sometime, a chance to buy bonds as the markets start to price in recession. I think we're seeing it in those cyclical sectors. We're seeing it in the macro, things, but markets haven't yet priced in recession. And there's a big question as to whether interest rates are still suppressed. I think when you look at a measure like the copper to gold ratio, which has actually been declining for a few weeks, interest rates still going up. A lot of these things point to, we could potentially be near a short-term top in interest rates, and it could be time to buy bonds, at least for a trade.
So you made a couple of interesting points there. So you basically still believe the bond channels are intact, and when rates are high at the top of the channel, you buy bonds, and when they're at the bottom, you sell bonds. So that's still going to work for the time being.
Well, I think there's a number of things going on. One, I mean, you mentioned interest rates, right? I mean, interest rates are so deeply negative right now. I mean, I don't use tips to try and figure out what implied future interest rate inflation expectations are. I just look at inflation's at 8.5%. Bonds are paying 3%. Whether it's the 10 or the 30-year bond. That's, deeply, deeply negative interest rates. And even if, let's say, inflation comes down to 4 or 5%, 3% is still not enough, right? So rates probably should go to 4 or 5%, something like that. But there's no way the economy, the housing market would get destroyed. And the federal government, we're over 100% debt to GDP. Just can't afford for that to happen. So I do think we're going to reach a point in time where the Fed doesn't want to talk about it right now because of the inflation problem. But we're going to hear more talk about yield curve control at some point if interest rates don't come back down on their own. Because I think the Fed is going to have to do something, whether it's 3.5%, 4% rate, something like that. The Fed is going to have to put a cap on rates because the economy and the government just can't afford higher interest rates.
So that basically would mean the Fed is going to do a U-turn sometime in the next 12 months, and the dollar is about to go down. Because if we start printing again or do yield curve control, probably the dollar is getting destroyed, because you don't have basically the Federal Reserve is trapped. If real yields keep going up, the economy, the government has a problem. But if they do something about it, the dollar has a problem. So is there any way out? Is there any soft landing, or are we heading
No,
for a
soft
real big...
landing is, I think, was it, I don't know, I think maybe Jamie Dimon came out and said today he thinks, soft landing has maybe a 1/3 chance. So 1/3 chance of a pretty mild recession, another 1/3 chance of a pretty deep recession. I think that's probably good handicapping. That I think I would even put the chance of a soft landing at less than a third. I think right now we're already headed for recession. And if the Fed's going to have to preserve its credibility, they're going to have to follow the forward guidance to some extent. But I think probably the markets have gotten ahead of themselves in terms of pricing in the hawkish rhetoric. I think, who was it? Larry McDonald was quoted in Bloomberg yesterday saying that, in 2018, the Fed was trying to roll the balance sheet off by $50 billion a month, but they'd also stopped raising interest rates. And we had a problem, right? We had the markets, really collapse. The stock markets start to collapse in late 18, and credit spreads widen out dramatically, and Jay Powell was forced to pivot. Now they want to do twice as much quantitative tightening, right? 195 billion a month, and raise interest rates from 0 to 2.5% or whatever they're kind of forecasting now as the terminal rate. There's no way they're going to pull that off without crashing the stock market and really hammering the economy. So, they're in a bind. They have to, as my friend Julian Brigden has pointed out, they have to tighten financial conditions meaningfully, just to at least make the world believe that they're doing enough to try and address inflation.
Yeah.
But I do think the Fed is getting close to they've waited way too long to tighten. Right now they're forced with tightening into a slowdown, and they can only do that for so long before they're going to have to put the brakes on again.
Yeah. We're from Europe. We have the EZB. They're waiting like forever. But anyhow, so if the Fed changes its mind, okay, we stop hiking the rates and we go back for a quantitative easing and lower the rates, then we see a big melt up in equities, don't we?
I'm actually bearish on equities right now. I don't think that there's no scenario that I can see where we see a melt up. I think what we've seen in a little over a year ago, in January of 2021, was maybe the most extreme speculative fervor in the stock market that I've seen in my career, bigger than the dot-com mania. Charlie Munger and Warren Buffett talked about this recently at the Berkshire Hathaway meeting. It's probably the most speculative environment in equities that we've ever seen. But now you've seen, this is an indicator I call the canary in the coal mine that I got from Jim Stack, which is, you look at the most popular speculative names in the market from a year ago, and they're all down 70, 80, 90%. So all of those people who literally thought stocks only go up, right? Buy the dip, that you can never go wrong, never lose money. Those people are now giving up on that idea, and they've blown their stimulus dollars on massive losses. So risk appetites have turned in a real way. We're seeing distress now in the corporate bond market, with a number of corporate bonds trading at distress levels have doubled so far this year. All these things go into a metric I term my risk appetite index. And really what you need to see a blow off in equities is you need to see risk appetites bottom and really take off to the upside. And I just don't see that happening right now. When you see spreads widening, when you see all the most popular speculative names get absolutely destroyed, to me that's a sign that we are now in the bust phase of a bubble that's already popped.
But do you think this bust will keep going on or not reverse after the Federal Reserve changes its course? So would you argue we basically have seen, or maybe have seen, the top in stock markets for the next 10 years? Or how do you see it playing out in the midterm once the Fed might ease again and
well, the Fed. So the Fed is. I don't necessarily see the Fed going into easing mode again. That's going to be very difficult for them politically. I think my point is more that they're going to have to rein in their hawkish plan, right? They're going to say, okay, maybe we can't roll off 95 billion a month. Maybe we can't continue to raise interest. Maybe we just put a pause in interest rate hikes. But so long as inflation is above 2%, and significantly so, they can't go back to printing money. It's too politically difficult for them to do that, right? The backlash in the United States right now towards, the Democratic Party, the party that's in power, is so significant that politicians are saying, Jay Powell, you have to do whatever it takes to rein in inflation. So I think that you're not going to see a pivot like we saw in 2018. They're not going to be able to go back to printing money. So, and a lot of people think that it's a very simple cause and effect between Fed policy and the market. It's not. It works through the channel of animal spirits, right? This is a concept that we've known that goes back to the beginning of central banking, right? Central banks have the ability to stoke animal spirits, essentially stoke risk appetites, get people excited about buying stocks. The Fed did this by lowering interest rates to zero, buying up all risk-free treasuries, and pushing people out on the risk curve into riskier securities. But that channel does break down at times. Just think about 2008 and 2000 to 2002, right? These bear markets were times when the Fed was easing, and at times easing very dramatically, and stock prices still fell 50% anyways. And that's, to me, a sign that once risk appetites shift in a big way from risk on to risk off, right? It's very difficult, especially, I just kind of published on my blog post about margin debt. When you see leverage so high as it was recently, we're talking about 4% of GDP, which is so much higher than anything we've seen in the past, and doesn't include billions of dollars spent on call options. It doesn't include asset-backed loans, which has become, really, really popular in recent years. Doesn't include, things like total return swaps that, funds like Archegos used to lever up. Doesn't include futures trading, which we saw, go to records in terms of net long exposure, in terms of speculation. Once this leverage starts to unwind, it's really difficult to turn risk appetites the other way. Every time we've seen leverage be put on in a way that it was a year ago, and 2020, early 2021, where you see margin debt rise at a rate of 50% year over year or more. The only times we've seen that were, just prior to the great financial crisis, just prior to the dot-com bust. We saw it in 1972, right before the 73-74 bear market crash. So every time you've seen this, the leveraging up, the deleveraging has created a decline of about 50% in the stock market. The only time it didn't was in 1984. You saw a big peak, run up in leverage in 83, but the price earnings ratio on the S&P 500 was 10 at the time. And debt to GDP was less than 1%. Margin debt was less than 1%. It was closer to its all-time lows than its all-time highs. So there wasn't much deleveraging to be done, and stocks were so cheap that, and interest rates had peaked, right, just in 82 or whatever, and had been in decline, structural decline for several years at that time, and we're going to continue to decline going forward. So all of these things are supporting stock prices in that one aberration. But the lesson from all those other periods was that when you see a deleveraging event kick off, like we've seen so far this year, risk appetites turn south and stock prices revert to some sort of a mean, where you need to see an amount of deleveraging, and you need to see valuations reach a place where they're much more attractive. We're still, in terms of valuations, we're still above the pre-pandemic peak in valuations right now. We haven't even given back the pandemic gains yet. So, and that would require the NASDAQ falling another 20-25% just to get to the 2019 valuation peak.
Very interesting, and I want to pick your mind on how to invest in such an environment. But before we come to that, let's think 12 months in the future. We actually have a deep recession. The Nasdaq, the S&P went down another 20-25%. Inflation probably rolled over, so probably we have seen the peak in inflation, at least for the time being. But if we have a deep recession, I guess you would agree, inflation went down by a lot. Oil prices, commodity prices in general went down a lot. What do you actually think happens then after the steep recession? Will we have really a depression over several years? What do you think happens then if a deep recession is on the horizon and plays out?
I'm not, we're getting into the economic forecasting, which is kind of a fool's errand. Right? I think right now we're in stagflation. I think that's obvious, right? We're seeing economy slow and inflation's remaining high. I don't see that changing anytime soon. I don't see commodity prices coming down a ton. I don't see oil prices coming down. I don't see a lot of these things, a lot of the problems in the market, food prices, right? If you just read about what's going on around the world, and farmers putting down 25% less fertilizer, during this spring growing season than they have, on average in the last few years, that food output is going to be down 15 to 20% this year, and potentially for a number, several years. So you see these kinds of structurally inflationary dynamics, not just in food, but in energy. The dramatic underinvestment in commodities that we've seen for 5, 6, 7, 8 years now is going to support prices. It's going to restrict supplies for a prolonged period of time. You look at just the green energy goals that countries have. And you look at the amount of metals required to meet those, and you're talking about a 3, 4, 5-fold increase in the supplies of copper, not to mention things like lithium and all these other things. So there's an argument to be made that for a number of years we're going to have structurally higher demand for commodities and structurally lower supplies, just as a result of the dramatic underinvestment that we've seen for a number of years. So I think, for me, that's the thing to glean from that is that I don't see a commodity price crash anytime in the future. I think that, the type of economic weakness we could see is more of a stagflationary type of thing, where you do have spikes in prices. They maybe come back down in commodities for a time. It's not a straight line for inflation or commodities bull markets. You have, but I think a pattern of higher highs and higher lows is probably what's ahead in the future. And that, puts a natural, dampening effect on demand that creates this kind of economic volatility. So I think we're probably in for that type of an environment, more likely than a type of, real depression type of scenario.
What's your worst case scenario? For example, if China says, okay, we put Beijing in total lockdown, or even more cities, or Russia invades Poland, or I don't know, the States, I don't know. So you have a plan B?
A
plan B for the
worst case scenario, for Black Swan, for example.
Yeah. Well,
gotcha.
I think that I think that probably the worst case scenario is probably unfolding. I really do think that the worst case scenario would be the Fed doesn't do enough to rein in inflation, and we get structurally embedded inflation expectations that create an inflationary period for a number of years that makes it that much more difficult for them to rein in inflation 5 or 10 years from now, when they finally are forced to say, you know what, inflation hasn't come back down. We're still looking at, we maybe even get periods in the low teens of inflation. And the Fed is forced to, into another Volcker type of episode where they have to raise interest rates to, into the teens, and really create a painful episode for markets and the economy in order to finally bring it under wraps. I mean, they're clearly not doing that now, right? To be at 25 basis points on the Fed funds rate when inflation's 8.5%, the Fed has never been further behind the curve than they are today. And so I do think that's probably the worst case scenario, just because, I mean, obviously depression and rapid inflation are both extremely painful for consumers, for the average person. But I think we felt what depression can feel like through the great financial crisis, with persistent unemployment pretty high, all these things. I think the Fed is now erring on the side of inflation. And so we're going to feel what painfully high inflation and persistent inflation feels like in the next 5-10 years.
So how do you protect your purchasing power? How to invest in those times?
So basically, how do you invest in a stagflation?
Well, I wrote a piece recently talking about this, and this comes back to you can tell I'm a fan of Stan Druckenmiller, but he back in 2003 or 4, he asked his investment team. He said, "Okay, pretend you just arrived on the planet from Mars, and I'm going to tell you nominal GDP is running 5-6%. The unemployment rate is 5-6%." Retail sales are, running the same. Where do you think the Fed funds rate is? And they all guessed 5-6%, something like that, right? Right around, CPI, which is running 3 or something like that, 3-4. And it was well below that. But if you do that scenario right now, imagine you just arrived from Mars. And somebody told you nominal GDP in the fourth quarter was running 12% in the United States. Inflation's running, 7-8% or something like that at the time, 7% at year end. The unemployment rate is pushing 4%, right? Where do you think the Fed funds rate would be? And nobody in their right mind would guess less than high single digits, right? 7, 8, 9%, something like this. They would never guess that the Fed funds rate was 0, and that we're printing over $100 billion a month in new money in that environment. So now pretend you're from Mars still, right? And I told you, now you know the Fed funds rate is 0. How do you think institutional investors are positioned in that environment? Well, I would guess, the Fed is clearly trying to inflate away the debt, right? They're trying to encourage inflation. And so how do I protect myself in an inflationary environment? I want to own real assets. I want to own real estate, commodities, and gold, period. And literally maybe a third of my portfolio is in those things, if I'm aggressive. The only reason investors aren't doing that is because investors, just like everything else in human nature, we're creatures of hindsight bias. We look back at the last 10 years and extrapolate it out indefinitely into the future, and we go, okay, well, commodities have done terrible in the last 10 years, right? I don't want to own those. And gold has been not so good. And real estate's been great, but prices are so high. So I don't want to do that. So investors are still in their 60-40 portfolios, or more likely 70-30, 80-20. I mean, you read a lot about retirees, in their 70s, 80s here, and they're 80% stocks, 20% bonds still. And that's just a product of hindsight bias and essentially investing by looking in the rearview mirror. I think when I just look at the pure macro environment, you go, I have to own gold, I have to own commodities, I have to own real estate.
You just mentioned retirees, and they are probably in the US. It's way more dependent on the stock market than, for example, in Germany. So don't you think the Fed will come to their rescue when the stock market is going down by 50%? A lot of those old people will be severely underwater. Don't you think there is something the Fed is going to do to help those peoples? Or is it actually too late and now we have to look at the big picture and they actually can't help them anymore?
So think about it this way. Wealth inequality in the United States is off the charts, right? It's been getting worse and worse and worse and worse and worse. So if the Fed, let's imagine the stock market crashes 50% tomorrow, right? I'm not predicting that. It's probably not going to happen, but let's imagine it does. inflation's running 8.5%, and the Fed is tasked with, okay, I can come to the rescue of the stock market, but if I do, I'm going to print a ton of money and make inflation worse. So who's affected more by what, right? Who's affected by inflation? Everybody in the United States, most especially the lowest income people in the country, are most affected by inflation. Who's most affected by a stock market crash? The top 1% who own the majority of the stocks in the United States. So I think we're going to reach a time where it's become politically impossible for the Fed to continue doing what it's doing, and inflation is what's going to be the catalyst for that. If the Fed tries to start printing money when inflation is still elevated, right? Then there's going to be major consequences for whichever political party's in power and is not telling the Fed that they can't do that. And right now, the Democratic Party is telling the Fed, you have to rein in inflation. They know they're going to lose big in the midterms because people are going to blame the Democrats for the inflation problem in the United States right now. So the Fed, it would be almost politically impossible for the Fed to come to the rescue of the markets right now, which is this is the discussion about the Fed put. And this is one of the things the stock market is trying to price in right now. So historically, the Fed put's been right about 20% below peak prices. Market goes down 20, Fed comes to the rescue. Happened in 2015, 16, happened again in 2018. The market has Jay Powell comes from the private equity world, and he understands the risks of allowing credit spreads to really rise to the point where defaults take off and you get a bad turn in the credit cycle. So yeah, that's why that Powell pivot happened in the way that it did, because he understands better than most how much leverage there is in the system, in private equity and elsewhere, and how bad that would be for the economy. At the same time, as long as inflation is elevated, it's very difficult for the Fed to come to the rescue of the market. The Fed put might be down 30, 40, might be down 50. But at that point, just like we saw in 2008, 2009, when risk appetites become that negative, it's very, very difficult. The Fed can print money. They might even come and print money and buy stocks. But what would that do politically? Politically, it would appear that the Fed has already come under tons of scrutiny, right, for the trading of top Fed officials that were buying stocks in the lead up to their March 2020 announcement that they were going to support markets. There's just a huge appearance already politically that the Fed is doing too much for the 1%, the top 1% wealthiest people in the country. Right now, they're tasked with reining in inflation because that affects the other 99%. And I think so long as inflation's high, they can't. Their hands are tied in coming to the market's rescue.
Let's shift back to commodities. Mark and myself, we have been talking about the commodity super cycle for 2 to 3 years, and especially 3-4 years ago, it didn't got taken too seriously by most people when we talked about oil being above 100 again and all that stuff. And you also mentioned gold. And I want to come back to your example. If I arrive at planet Earth, you tell me the Fed is printing money, inflation is at 10%. What do you think is the price of gold at? I probably would say around $4,000-5,000 US dollars. But in reality, it's at $2,000, while basically all other commodities are doing all-time highs. So what's going on there?
It's a great question. And my answer is the dollar. I think it's been astounding. The gold price has remained so strong, even in the face of the dollar going parabolic to the upside. Right, the dollar's had a super strong run in the last few months, and the gold price has held its own. So I think what's going on right now is you have rising nominal interest rates, right, which are headwind for gold prices. At the same time, a rapidly rising dollar, which also puts pressure on the gold price. So the fact that it's actually risen for the last 6 months or something is a very bullish sign in my view. But what is the dollar pricing in? The dollar is pricing in the most aggressive tightening, by the Fed really since Volcker, since Paul Volcker, in the early 80s, late 70s, and so That is what has been driving the dollar rapidly higher. I think we're approaching a point in time where the economy is going to weaken significantly. We're already seeing it in a lot of signs. I mean, you look at consumer sentiment numbers, and the Michigan sentiment versus, what's the other major consumer sentiment report? I can't think of it off the top of my head, drawing a blank. But the difference between these two is usually a very good early indicator of recession, right? You have and especially consumers saying, we anticipate our financial situation to deteriorate in the months to come, is another good early warning signal for recession. We're seeing a lot of these things in addition to cyclical sectors in the stock market and whatnot. So I think the Fed is going to be faced with a point in time very soon, because they've waited too long to tighten, that they're going to raise 50 basis points today. They're going to try and raise another 50 in next month. But I think they're going to be faced with a rapidly slowing economy here really soon. And then the pressure is going to reverse for them to just hold off for a little while. I'm already seeing it, right? There was a big op-ed in the New York Times recently where the editors of the New York Times are saying it probably makes sense for the Fed to take more of a wait and see approach to inflation, even still, and still kind of give it time to see if inflation's transitory or not. And that's I think where we're going to hear more of that kind of talk as the Fed tries to follow up its hawkish rhetoric with actual implementation of policy. And at that point, the dollar is going to say, hey, wait, maybe we priced in too much. Maybe the Fed isn't going to be able to roll off $2-3 trillion on its balance sheet without creating problems in the money markets. And they're not going to be able to raise rates to 2.5 without crashing the economy.
Do you expect the ECB will follow the Fed and hike rates?
There's slightly different dynamics, in Europe with reliance on Russian energy and these types of things. So, there's even more of an argument there to kind of look through what's going on with inflation. But I do think probably the ECB seems like they're basically just following the Fed, several months afterwards. So I do think the Fed's going to start rising. We're in this situation where no central bank can afford to be more aggressive than the Fed, right? The Bank of Japan is trying to be extremely dovish, in the face of Fed policy. ECB too is they all have to be relatively dovish to the Fed. Otherwise, you get currency headwinds that compound a lot of the problems you're already seeing in recessionary types things. So I think for the ECB to be even more hawkish than they are risks rally in the euro, which they can probably afford now after it's weakened so much. But I think probably we will see a tightening, there, especially if now that the euro has weakened significantly and they can afford a little more strength.
Do you have a general outlook on Europe and Germany? Most of our listeners are from Germany. We have a war going on in Europe. We have an energy crisis. We have also an economic slowdown. What do you expect from Europe over the next couple of years? Is there any hope, or are we in some sort of death spiral over here?
Well, I really wish that, I can wish all I want, that, there would be a renewed push, or had been for the last several years, back into nuclear, because I do think that's going to be a very important piece in this transition away from fossil fuels. That we can't do it with just, green energy alone. We can't do it with just wind, solar. That we're just. So this has been a problem around the world. Is this idea that we're going to be able to just turn off fossil fuels tomorrow and transition to green energy? And I think in Europe this has been a bigger policy mistake than in other places, and so now we're feeling the consequences of that mistake. And so I think the sooner that we see countries embrace nuclear in a big way, the better, because it's going to help with this transition period that we need to transition off fossil fuels. I absolutely agree with that, but we're not going to be able to do it anytime soon. Even if, we were to start selling, just ban the sale of combustion engine vehicles, it's still going to take decades to phase out the use of fossil fuels, because those cars stay on the road for years and years and years, and it's going to take several decades for, even if you banned the sale of combustion engine vehicles today, it'll still take decades to transition the world economy off of fossil fuels. So this transition is going to take a lot longer than we thought, and by punishing companies for producing fossil fuels for the last 3, 4, 5 years through ESG mandates and through government policy and these types of things, we have essentially ensured that energy prices are going to remain elevated for a long period of time. So I think it's a very difficult position that Europe is in right now, simply because of the reliance on energy from Russia and the, I think, over-optimism and being able to make the transition to green energy.
What's your favorite uranium stock?
It's funny. So for me,
you don't have one.
I have all these macro theses, right? But when it comes to expressing them as a trade, right, that's something totally different. And so I don't own any uranium stocks at all.
Okay, so you have to read my book.
My equity process they just haven't fit my trading process as of yet, which is a kind of more long way of saying I haven't seen any insider buying in the uranium companies, and that's really one of my top fundamentals. Is I follow top executives of these companies, and unlike in energy, so in energy in the fall of 2020. We saw energy executives come in and step in and just almost like they wanted to individually take their companies private. We're going to just take all the top executives' money and we're going to buy up all the stock. They were buying stock hand over fist. Harold Hamm, Continental Resources, came in and bought like $150 million of Continental in August of 2020. And he said, I'm going to continue buying stock personally until I don't think the stock is cheap anymore. And he's still buying, $15 million here, $20 million there. A lot of the energy infrastructure stocks, like the pipeline companies, have had massive insider buying for the last 2 years, and so that's really what drew me to energy back then, and even in precious metals, we've seen it in the miners, and so I haven't seen that in the uranium stocks. Maybe that's just for lack of looking. Maybe that's just my fault, but. It really just hasn't fit my equity discipline just yet.
So, but when it comes to commodities, you're more focused on oil and gas companies, on precious metal companies, maybe on copper companies. Are those your favorite commodities to own?
Yeah, I think I'm pretty much focused, in energy, and I'd say oil and gas producers. And in precious metal miners right now. One of the things that I'm most excited about the gold price right now is that when you look at the Commitment to Traders report, they break it out into managed money and producers. So you can actually see what gold producers are doing in terms of their hedging. And right now, the gold producers, relative to open interest in gold futures, gold producers have their smallest short position really since late 2018 and since 2015-16 before that. It's a level where they are so confident in higher prices that they're not selling forward any production right now, gold miners. And you see a similar situation in oil too, where oil producers aren't really seeing the need to hedge at all. And so that to me is the smart money telling you supply and demand is very bullish for these things right now. That prices are probably headed. Probabilities are that higher prices are much more likely than lower prices for both commodities right now.
When it comes to oil and gas, I have one final question, and I have to come back to this deep recession that might be on the horizon. Usually, during a deep recession, oil prices go down by a lot. Why do you think it's going to be different this time? And if you're so certain about a recession, and I tend to agree, would it not be better to actually wait for that recession, for oil prices maybe not going down to 20 but 50, 60, and probably oil producers coming down as well? What are your thoughts on that?
Well, I think we have to identify what type of recession, right? What is recession, right? I don't think any recession we're going to really see a decline in nominal GDP. I think it'll be a decline in real GDP, where economic growth is slower than the rate of inflation, but nominal GDP remains elevated. So I think that that's the type of recession that I see ahead. It's not the type of recession you traditionally think of, where nominal GDP is declining. You see the inflation rate come down, maybe even go negative. I think, inflation rate might come down into the end of the year. Let's say it comes down to 4 or 5, but nominal growth comes down to 2, 3. To me, that's recession. And I think that's probably what we're going to see, is that type of thing, where we see, retail sales in real terms decline, but not necessarily in nominal terms. So I just think it's going to feel like recession just because prices are rising faster than nominal growth. But it's not going to feel like recession from the standpoint of everything is going down in price.
Got it. Makes sense.
So what's your favorite mining stock? I have to ask, sorry.
Or your favorite?
My favorite mining stock is probably Agnico Eagle. I think that it's one that is probably the highest quality company major in the group. It recently became out of favor due to COVID issues with production and whatnot. But the stock is really cheap. One of the things I do, I was kind of laughing about this with my readers a little bit, is for 20 plus years, I look at value line reports, right? They're just, they send out a report every week and it covers whatever it is, 100 stocks. And I just literally flip through and look at every single stock, because what I love about Value Line is they show you the stock price relative to essentially it's a fair value line. They call it the value line, which is basically based on its historical valuation. And when you look at, you flip through the gold miners, and Newmont's performance has been terrific. Agnico has fallen to the point where it's about, it was maybe a couple of months ago trading at about a 50% discount to its fair value based on historical valuation. So you've seen some insider buying there, and I think just they have such good quality mines in good jurisdictions that it doesn't deserve to trade at a discount to its peers. It deserves a premium like it's typically traded at. And I do think Agnico Eagle is probably my favorite.
Okay.
So let's get one more pick. Jesse, what's your favorite oil and gas stock right now?
Well, I mentioned the two that I've owned for 2+ years now. I mentioned Continental Resources, and I do like that one, and it's because they've not hedged. They've traditionally not hedged their production. They've said we're just going to live with the volatility, but they are. That makes it very attractive. I've also liked just the oil and gas producers. A lot of people have bought, the services companies and the integrated companies. But then you get into the economics of refining margins, and these which are fantastic right now. I mean, I've owned PBF Energy too, but I like the companies that are just most leveraged to the commodity itself and don't have a lot of other businesses to get in the way. So Continental's one of those. In terms of integrated companies, Occidental is one that I've owned for 2 years now. Warren Buffett recently started buying a significant position in Oxy also, but those are the two that I own.
Okay. So where do you see the gold price in the next years?
I mean, right now with where real interest rates are, I mean, the gold price, I think, should be at least $3,000 an ounce. I think that as soon as you get, if the Fed blinks, right now they're on just hawkish, pedal to the metal. We have to raise interest rates, roll off the balance sheet $2-3 trillion. If they blink and just say, all right, maybe we can't raise interest rates as fast as we wanted to. Maybe we can't roll off the balance sheet as fast as we want. The gold price will break out to new all-time highs as soon as the Fed blinks. And I think probably it is undervalued by at least $1,000 an ounce. So it could go to 3,000 pretty quick.
What's your take on Bitcoin, the digital gold?
So I don't own any cryptocurrencies. I've avoided them because, as going back to my roots as an investor, I like to look at things that I believe have some sort of intrinsic value. That I really strongly believe, I can come up with a price of this is worth X, right? This is worth $50 a share. So if I can buy it at $25, $30 a share, I've got a good margin of safety in there that reduces my risk. And I haven't been able to apply that framework to cryptocurrencies at all. And so it's difficult for me to kind of wrap my head around them. So for that reason, I've just avoided them.
Fair enough.
You want to end with some rapid fire questions?
Yeah, we have some rapid fire questions for you. You just can answer pretty short. So what do you think? How high will the dollar go, or how low will the euro go?
I think we're really close to a top in the dollar, low in the euro. I would just love for Gisele Bündchen to come out and say, I'm only going to get paid in dollars from now on. If she were to do that, I would go, super short dollars, long euros. Just like she did, whatever it was in 2008, right? Vice versa, right? It was 2008. I think she said, "I only get paid in euros from now on. I won't take dollars," and that was the top in the euro.
Yeah, exactly. Yeah, contraindicator. So, what do you think? Will the euro still exist at the end of this decade?
Great question. I think so. I think, the sentiment right now is probably a little too negative that, it's going to go in waves, and I think it'll probably still be around.
Okay. And what do you think? Will the US dollar be still the reserve currency of the world by the end of the decade?
It might still be the reserve currency, but the use will go down. I think we've already seen a peak in dollar usage, and as we see deglobalization and these types of things, the usage of the dollar will go down.
Okay, what's your target price for the S&P or the Dow Jones at the end of the year?
End of this year, let's say 3,000.
For the Dow.
For the Dow. Not 3,000. Okay. S&P. The Dow, I don't know. Let's say 20,000.
Okay. But don't you think the Fed will step in and stop this madness and, I don't know.
I don't think so. I think that they as long as inflation's high, the Fed put has expired. Okay. They need to bring inflation down in order to come into the market's rescue.
So what are top 3 investments for the rest of the year with your scenario? Like canned food or? Gold.
Gold.
Okay, perfect.
Then the final question, any price targets over this decade for gold? So you just mentioned $3,000, so that might be a target we can achieve within 12 to 24 months.
There have been times over the last 100 years where the Dow Jones Industrial Average and gold price have achieved parity. I think we're going to see that again sometime in the next 5-10 years.
Yeah, when the Dow hits 3,000 at the end of the year, like you said. Okay, final question, Jesse. It has nothing to do with finance or macro. What's for you the meaning of life?
The meaning of life, I think, is... all right, it's
macro.
Impossible question to answer. I think it's connecting with other people. I think we're social creatures, and that's why it's really fun to do things like this. It's why I started my podcast. I think this is such a difficult process. I mean, it's the most difficult game in the world, as Paul Tudor Jones, is called, most interesting, most difficult game in the world. And so to basically share it like this in this type of a format and have these types of conversations and discussions, I really do think the meaning of life is connecting with people over whatever it is, whether it's finance or, love or, what have you. I think it's this social connection.
Beautiful. I think that's a perfect end, isn't it?
It is.
Yeah. Thank you, Jesse. It was great talking to you, and I hope to invite you soon again.
Final question from my side. Thanks for a terrific interview, but where can we send people to learn more about you or to
Exactly.
find
Yeah,
you on the internet?
I'm pretty active on Twitter. I just tweet a bunch of charts and articles that I read throughout the day. That's just at Jesse Felder on Twitter. And then thefelderreport.com is my website. I try and put up a blog post or a podcast once a week.
Yeah, we put it in the show notes, definitely. Yeah, cheers. Thank you for everything. It was great talking to you, and I hope we do this again.
Thanks, guys. Appreciate it. Had a great time. Thank you.
You too. Take care, Jesse. Bye.